Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to go in depth and talk about deferred annuity rates and go through a thorough review, showing what the difference between like an annuitization phase is, what a income rider would provide, and then how to really expose, some of those what I like to call smoke and mirrors with certain insurance companies when they're offering their deferred annuity product lines, and how you can really determine whether you have a good annuity contract or a bad annuity contract, or if you have an insurance agent that's basically pitching you an annuity, how you could determine whether or not that's really the best for your situation. So what happens with deferred annuities is we understand that there's going to be some sort of deferral set up for this type of plan. So let's say that an individual is age 55 and he's looking to retire at age 65. Well, this person can place their retirement assets, whether that's in checking, savings account, money market account, if it's set up with qualified retirement accounts such as like an IRA, 401k, old 401ks, old thrift savings plans, old 403bs, different things like that, that allow an individual to take those remaining assets and place it into a type of annuity contract. If it's from cash, then it has to be placed into a non-qualified annuity contract. If it's coming from qualified retirement accounts, well, then it would have to be rollover or transferred into an IRA qualified annuity contract. So it'd be like an IRA with an annuity chassis over it, to make sure that it's going from like to like terms. So when this is established, this individual might say, okay, I have IRA monies that are sitting there, I have cash monies that are sitting there. Essentially, I have about $500,000 of my retirement savings at age 55 that I want to try to leverage, because I understand that the day I hit 65, I'm out. I don't want to work again. I want to enjoy my retirement. This is essentially why I have saved, all these different assets, was to hit this finish line right over here. So what happens is we understand with this individual situation, he has a goal of a 10-year deferral. So therefore, we want to look at the best 10-year deferred annuity contracts. You have these types of products out there which are known as DIAs, deferred income annuities, which act very similar to the traditional annuities known as a SPIA, single premium immediate annuity. And these were annuities that got a lot of bad press. I don't like them because I think that you're losing a lot of control. And I think that the DIA contracts, you're losing a lot of control as well, probably a little bit worse than how the SPIA contracts work. What do I mean by that? Well, what happened was with traditional annuities, an individual would go to an insurance company and they might say, okay, I have $100,000 and I'm, 65 years old and I want to receive lifetime income. So out of this $100,000, what the insurance company would do is say, okay, we're going to calculate our actuarial table, say that this person's age 65 right now. We're going to, if he pays us $100,000, we're going to provide him back $6,000 every year to the day that he passes away. So if this person keeps living, lives past 20 years, lives past 25 years, etc., he won because the insurance company is paying him $6,000. After 20 years, the person made $120,000, and it only cost him $100,000 to do so. Now, the downside with this, with the single premium only immediate annuities, was that if this person passes away after the first year, well, now the insurance company is walking away with the $94,000 profit. They get to keep all that money. Nothing goes to the beneficiaries. So this is a very simple concept of annuitization. With the deferred income annuities, it's very similar, except for you can't touch this money. You're basically placing that same $100,000 goal, placing into a contract, and they're saying, okay, we're going to defer this to age 65. At age 65, instead of like $6,000, maybe this person's going to get $8,000. The downside to that is if you pass away, if you don't have, let's say if you're just going to a plain deferred income annuity, single life only, with no sort of return of premium riders or anything like that, if you passed away at age 62, well, the insurance company now got to keep the full 100,000. Let's say if you live to age 65 and then you start triggering income, you live age 65, 66, 67, God forbid you pass away, you come with an ailment, you pass away, you would have been paid out $16,000. the insurance company would have been able to take that 100,000, make monies off of those monies, the time value of money, would have been able to secure that $100,000, make interest off of that money. They would have only paid out $16,000, and therefore they would have kept $84,000 of profit on top of what they've made off of that investment for those 10 years. So that's why I absolutely hate deferred income annuities, and that's why many times the hybrid annuities are a better route in this sort of situation. Now, any sort of deferral, if somebody's 62 and they're looking to retire at age 66, that's a 4-year deferral. It doesn't have to be as drastic as a 10-year deferral or a 15-year deferral. It could be something as small as a 1-year deferral, as a 2-year deferral. Just something that says, if I go and I place my dollars into an insurance company, what exactly would be the highest benefit that I could get at all angles? Meaning, what's the highest income I can receive? What's the highest growth I could receive on my account? If I pass away too soon, is my account value going to my beneficiaries? The money that I did not touch? If, let's say, my account value goes all the way down to $0 because I kept living, is that insurance company still on the hook? And those are the type of annuity contracts that we recommend because it just gives you full leverage, full control, rather than surrendering all that control to the insurance companies. If you could keep the control with you and pinpoint the best possible product and the best possible strategy, well, then obviously you're going to be very happy in retirement and understand whatever you don't use up will go to your beneficiaries. Everything that you saved up for retirement did not just go to waste. So let me clear off the screen real quick. And I'm going to keep that $5,000, that $500,000 example on the board. So if we had that male, age 55, and at age 65, he says, I want to retire. Well, then it's very important to understand what his income sources are. It's very important to understand what sort of guaranteed lifetime income he's going to be receiving at age 65 and base it upon what his budget is. So if he goes and does a budgeting analysis and he says, okay, well, currently my expenses are $60,000. By age 65, I'm going to have a couple of things paid off. I'm not going to need as much as the $60,000. At age 65, I project that all I need is $50,000 to live off of for income. So if we understand this concept and we understand that his bucket is $500,000, well then let's figure out this monies. Let's see exactly what the income sources are. And then, so we're going to plan for the future and go backwards. So what I mean by that is his goal is $50,000. He's age 55 right now. We're looking for a deferred annuity rate that's going to be the best for a 10-year deferral. So in this situation, we understand maybe he's receiving Social Security income of $30,000. He's not receiving a pension income, unfortunately, and he has these retirement assets of $500,000 with the 10-year deferral. Retirement savings. So what we could do is say, okay, we need $20,000 of an annuity contract, $20,000 of lifetime income at that age 65. So what this says is we understand that Social Security is going to kick in $30,000. We need to get to $50,000. Out of that concept, let's scale backwards. What is going to be the highest contractual guarantee, the best contract for a male age 55 in his particular area that's going to provide him $20,000 of lifetime income? You could go into the variable accounts and say, okay, I want to try to grow this money, but that's when you fall victim to reverse dollar cost averaging of mutual fund related fees, advisor fees, downward market loss potential, pulling money from accounts and inflation. So that's why we typically don't recommend throwing your dollars into variable accounts into speculation. We want to have certainty in an uncertain world. We want to say, if we could accomplish your goal with the best lifetime income, deferred annuity, and the best rates, why, that would make the most sense. So we're only taking the smallest dollars of this $500,000 to accomplish this $200,000 goal. So with that being said, you have these different things out there known as like hybrid annuities. And I talk a lot about hybrid annuities, and I say, about 90% of those products, 95% of those products are typically garbage in a situation, but those 5% that are good are amazing products for an individual situation. So if we have company A, let's say we have 3 companies that come back in first, second, and third place. Company A determines that it's going out of this $20,000. It could accomplish its goal. It could accomplish the lifetime income goal by only using $200,000. Company B with the same rating requires $275,000, and then Company C requires $350,000 of an initial deposit. Well, obviously we're going to go with Company A because of the fact that we're going to use less dollars, have the same quality contract, and it's going to provide us lifetime income. rather than use a annuitization where you're losing control, or deferred income annuity where you're losing full control of those monies. With a hybrid annuity, it's a combination of a fixed index annuity with an income rider. So it allows your account to grow when the market goes up, gain 0% whenever the market goes down, receive something known as a roll-up rate percentage on your income base, and trigger lifetime income, so that when it comes time at age 65 to trigger that $20,000 of lifetime income, it's coming off of the income base. That number is slowly getting depleted on your physical monies to decrease that account value, but your account value still has a fighting chance against inflation, and still allows you to, because this account is not going with downward market losses, it's still allowing it to grow as you're siphoning out monies, to leave monies to your beneficiaries. So in this situation, what happens many times is an individual say, oh, well, I was contacted by company C. They were telling me about this 10% premium bonus. They were telling me about the 7% roll-up rate. When in actuality, when you open up the hood, what is the exact dollar amount that you're going to be receiving on a guaranteed lifetime income basis? Is that going to be the best contract in your area when you go through over 1,200 different options? And that's the power that we try to give individuals. As we say, we're an independent agency. We want to make sure that we have access to every single carrier possible, so that when calling into the agency, you have that peace of mind that we could send you. We could talk about all the pros, all the cons of these different carriers, and then place you like a perfect puzzle piece into this type of contract. Let me clear up the screen real quick. So with that situation, if it only required a deposit of $200,000, well, now this individual has $300,000 left over in emergency and inflationary protection to grow those monies. You didn't have to go and place the full $500,000 into annuity. What happens too often is you have a captive agent that works for a specific company. When somebody comes to their office, they're only going to be talking about that one company, just like company C, where they'd have to use $350,000. And then what they're going to try to do is tell them, yes, it's going to require $350,000, but look at what this, if you place $500,000 into this annuity, what that could do for you, how much more income that could provide to you. And annuities are very good on an income play and a consistent growth play, but it's not really good on the return. So we're basically, with annuity contracts, a lot, especially with the fixed index annuities, with income riders, just fixed index annuities, it's providing you that peace of mind that the markets crash, you're going to gain 0%, you have that 0% floor, but it's not going to be giving you these astronomical rates of return. You're a lot better suited going into managed money, into variable speculation accounts, but you do not want to have your monies in speculation if you do not have your income sources set up yet. So make sure, in this situation, we made sure the income sources were set up. It only required $200,000. We're going through all the top carriers. You had $300,000 left over. So now you have emergency funds, plentiful amount of emergency funds. Typically, emergency funds usually leave about 6 to 12 months of your expenses in an emergency, meaning liquid cash, money market account, whatever that case may be. And then the third aspect is you want to make sure that you're setting up for inflationary protection. So maybe at age 65, he's receiving $20,000, but then how exactly can we receive little step-ups in income with different sorts of either annuity contracts or things that are going to provide him lifetime income amounts to make sure that you have a fighting chance against inflation, or even just growing those remaining monies. So there's a whole slew of different things. Don't fall victim to the common mistakes of just listening to an agent and him not showing you the proof, of just saying, oh, trust me, or just showing you one company. You want to make sure that you're going through the ringer and saying, if I'm placing a single dollar with a contract, or with multiple contracts with multiple companies, I want to make sure that it makes sense, that I'm receiving my control, I'm having my growth into my accounts, I'm receiving my lifetime income, I'm not just surrendering it all to the insurance company. And the insurance companies, they do a lot of smoke and mirrors where they're trying to incentivize individuals with premium bonuses of like a 10% premium bonus, like I mentioned previously. And sometimes you have contracts that don't even have a premium bonus, and it puts you in a much better position than that company that gives you a 10% premium bonus. It's that nice shiny object that is good there to distract you and to incentivize you to go into that sort of plan. So, we want to make sure that you're constantly educated on the best types of annuity contracts, best types of deferred annuity rates, and at any point in time, let me clear up the screen. Feel free to call our 1-800 number. It's 1-800-566-1002. We work on a national basis. You give us a call 24 hours a day, 7 days a week, mornings, nights, weekends, holidays, whatever the case may be. Basically, what you can expect with the process is you'd speak with a specialist, you tell them your situation. Maybe you're interested in in deferred annuity rates or some other form of retirement planning. And that specialist is going to, that assistant is going to patch you over to a specialist, and they're going to ask you a slew of questions to figure out the 30,000-foot view. Okay, what's your situation? What are your goals? How can we accomplish your goals successfully? What you're doing might make sense. And there's many times that we tell individuals, listen, yes, there's no reason to shift around your assets and place monies into an annuity if you're already receiving your income goal properly, because there's restrictions with annuity contracts. The insurance company is providing you lifetime income, but you're also surrendering a lot of control. You have restricted liquidity of those monies, and you have to play by the terms of the contract. And that's why we always stress, place a small amount of dollars in there as only as much as necessary to receive that lifetime income specific to your needs. You deal with that specialist that might give you some recommendations. We educate through video tutorials, the literature pieces, and this is one of the reasons why I believe we've had this A+ rate on the Better Business Bureau with good reviews and no complaints, is because we try to educate individuals. We don't try to talk over them, and we make sure to explain everything in a simplistic process. So you might be dealing with myself, you might be dealing with one of my other representatives, depending upon your area, and but I want to thank you very much for watching these videos and subscribing to our YouTube channel. And at any point in time, if you have not subscribed yet, make sure to subscribe to Retire Sharp or visit our website retiresharp.com, so you have access to the most updated videos and some good educational pieces and some good ebooks. So thank you so much, guys. I look forward to speaking with you, and we'll go from there.